The Great Recession played havoc with the prevailing monetary policy approach employed by central banks until its onset. As seen in Chapter 1, this was based on three unacknowledged but critical conditions. 1. The central bank can tightly control its interest rate, that is, the rate chosen as the operational target. 2. There is a stable relationship, both for current and expected values, between the central bank rate and longer, riskier market rates, which have a much stronger direct impact on the macroeconomy. 3. The central bank can either cut or hike its interest rate by any desired amount, depending on the circumstances. In one or the other phase of the Great Recession, one or more of these conditions no longer applied. First, central banks found that it had become more difficult to steer their dominant tool, namely the interest rate. Second, the relationship with longer and riskier rates had become very uncertain, and thus the interest rate's previously estimated impact on the real economy and prices no longer held. Third, the lower bound for nominal interest rates constrained central banks' ability to reduce interest rates. More specifically, control over the short-term interest rate became imprecise in the first phase of the Great Recession, as the bank's demand for liquidity could no longer be properly estimated and offset by central bank supply. In addition, the relationship between the short-term risk-free rate controlled by the central bank and those rates directly relevant for the economy underwent two episodes of extreme uncertainty and volatility. The first episode took place in the American phase of the crisis after the bankruptcy of Lehman Brothers and the massive bailout of American International Group, AIG, in the autumn of 2008. The second episode came in the European phase of the crisis after the revelations about the misreporting of Greek fiscal data in the autumn of 2009. Finally, the ability to reduce interest rates was severely impaired during the most advanced phase of the crisis, when the interest rate had already reached its lower bound or moved close to it. The way to visualize these developments is to consider the interest rate most directly controlled by the central bank as the hinge of the entire yield structure of interest rates. As seen in Chapter 1, the central bank steers the economy by changing its interest rate. These changes are then reflected in longer, more variegated interest rates along the maturity and risk dimensions. This is the starting point of monetary policy transmission, as these latter rates influence the behavior of economic agents. With the crisis, the ability to set and maintain the hinge of the structure of rates at the desired level and to influence other rates along the maturity and risk curves were severely affected. Eventually, when uncertainty about the longer-term economic outlook escalated, the final part of the transmission, that is, from interest rates to real economy and prices, also changed considerably. The difficulty of steering the central bank rate, the substantial uncertainty affecting its relationship with other macroeconomically more relevant rates, and the problems created by the so-called zero lower bound, ZLB, or effective lower bound, ELB, are illustrated in turn. 2.1.1.1 Difficulty controlling the interest rate. The first symptoms of the crisis were seen already in August 2007 in the money market. The demand for liquidity grew significantly and irregularly as banks wanted to hoard liquidity for precautionary purposes, making demand for it much more volatile and harder to project. The European Central Bank, ECB, and the Federal Reserve Bank, Fed, tried to offset this by increasing the elasticity of liquidity supply, but they could not really calibrate it to offset the sharp changes in liquidity demand. As a consequence, the Euro Overnight Index Average, EONIA, in the Euro area and the FFR in the USA started to fluctuate significantly more than before the crises. The instability of the central bank rates grew disproportionately after the failure of Lehman Brothers. The reassuring conclusion before the Great Recession that both central banks could tightly manage their rate around the objective by means of the corridor approach, Papadia and Valimaki 2011, was lost. It was only in the more advanced phase of the crisis, when central bank liquidity became overwhelming, that interest rates stabilized, this time not around the center of the corridor but close to its bottom. These developments are visible in the case of the ECB in a visual study. As evidenced in the study, EONIA was quite stable at a level just above the rate applied in the main refinancing operations, MRO, until the summer of 2007.